because I'm student.
So as per usual, the sessions are recorded. Anything that you miss, you can catch up on afterwards. It'll be uploaded onto the VLE. Welcome to module 11. It's our second last one, finance and financial management. I am going to, before we get started, remembering we've got peer groups this Thursday. I'm not going to be there, but Alan will be there, normal times. So please do join. I'm going to pass over to Lee. Lee's got some information for you all about the sort of alumni stuff. So I'm going to pass over to her for 5 minutes before we start the session. So over to you, Lee.
Super, thanks Jess. Hi everyone, good to see you all. I recognise a few of you from the induction, but for those of you I haven't met, it's lovely to see you. Like Jess says, I'm just kind of jumping in for 5 minutes to chat to you briefly about the alumni programme. We're now on week 11, so next week is your last week, sadly. So you're approaching the end of the programme, and what does this mean for you? Well, it basically means you're about to join the alumni community, not only within UWS, but also within the kind of UK-wide Help to Grow management community. So anyone that completes the programme gains access to this. It means you can engage with businesses from all over the UK who have taken part in the programme at different business schools. And in this, you get access to the content for an extended period of time, but you also get to come along to our UWS alumni events. For Help to Grow, we're thinking about November, December time, but this is going to be led by you guys because obviously we want as many of you to be there as possible. Alan is coming down next week, Dr. Alan Murray, so I'm going to give him some little form things for you guys to fill in. There does have to be a kind of learning element to the event, which is a little bit boring, but that is the requirement for cabs because it is a free event for you guys, and there's usually food and drink and everything else like that. So it would be really good if you could give us a flavour of what it is that you would like to get from an event like this, and we'll do our best to make it happen. Alongside this, you can also attend our regional alumni events. Now there is one happening in July. I think it's on the 13th of July in central London. I'll be coming down for this. I went to the Glasgow one last week and it was really good. I would really highly recommend coming along. There's lots of kind of guest speakers and masterclasses, panel discussions, things like that. So I don't know if you have already had emails about this because you're not technically completed the programme, but because you're nearing the end, you might very well have. So if you've not, I'll send on a little email about this after today's session. If you could just let me know in the chat whether or not you've received this already. And then the last thing, kind of briefly, again, you'll get more messaging on this from the Small Business Charter, but it's your CMI membership. So on completing the programme, you get 6 months membership for free to the Chartered Management Institute for you to continue your learning, but also to extend that learning to your members of staff as well. So it's something worthwhile taking advantage of because it is free. And then past that point, if you want to continue, you can. So if anyone has any questions for me while I'm here, just drop it in the chat. I'll stick around for a little bit, but if not, like I say, I'll email on some information and hopefully I'll see you guys in London quite soon. Thanks, Jess.
Great, thanks, Lee. Okay, so we're going to get started on the session. Just remember to get the most out of these sessions. Our wonderful lecturer is here to ask loads of questions too. So at any point during the session, if you have a question about the content or how that relates to your business, or you would like some advice, please drop in. Obviously, there's content to get through, but we are here to make it as applicable to your businesses as possible, so it can be a conversation. You can take part in by unmuting or in the chat function. Cameras on is always really appreciated. It shows that we're all alive and paying attention and giving the content our full attention. So without further ado, I'm going to pass over to Ayo, who's going to introduce themselves and start us off on finance and financial management.
Thank you very much, Jessica. My name is Ayo. My real full name is Ayodele, but just call me Ayo. That's easy for everyone to call because I don't want you to break your teeth because you want to call my name. Just say AYO, that's finished. As if you want to call Ion. So once you call Ayo, I'm okay by that. So I will be handling this module 11, which is finance and financial management. Before I start, my name is Ayo, as I've said. I'm a chartered accountant. I have been a chartered accountant for over 23 years. I'm a member of Institute of Chartered Accountants, England and Wales. and I'm also alumni of University of Liverpool. I did my master in Liverpool, and also I completed my PhD with the University of West of Scotland. I'm a lecturer in accounting and finance at University of West of Scotland, London campus. Before then, before joining UWS in 2009, I've been an auditor for over 22 years, at a medium-sized accounting firm consulting for companies across 3 continents, UK, Nigeria, and US, particularly just 2 companies in US, a solar company in US. And I've been training people across the globe. I've worked with United Nations when I was with my medium-sized firm, which is BBC Professional. I've been a tax consultant. I've walked around the accounting profession. Feel free. Today is not a normal lecture. This is not a lecture. Let's call it business clinic. Okay? Let's call it business clinic. So feel free to ask questions that relate to your business, that relate to your concern about your accounting, in audit. At every point in time when I'm going too fast, let me know, because it may be interesting and I want to go as fast as possible so that we can have time to have a robust discussion. So feel free by, unmute yourself and call my attention to it. So just relax, enjoy your clinic, and, here we go. So if you have any question, let me know. So I'm going to start with the topic itself, which is finance and financial management. Before I start talking about, the real thing in our slide, I just want you to know that, finance and accounting is a very important aspect of our life. Be it a businessman, be it an employee, is useful to everyone. You can't throw away the knowledge of accounting. So as a businessman, you may not be involved in the preparation of the account, but you are going to, read the report given to you or the account given to you. So this knowledge is going to help you tremendously now and even after this class. You are free to contact us. We'll be there to support you. Okay, so Help to Grow is a very special scheme. You are all used to the roadmap of the Help to Grow. You can see from you've done strategy and innovation, and you've done digital transformation, how you can win the market. I'm sure my colleagues must have done justice to that. I know some of them very well. Must have talked about the vision, because every organization without vision, mission, and value, it means you're just like someone traveling without a map and doesn't know their destination. And I believe that has been sorted out before now. How to develop a marketing strategy. We all know that now we work in a very dynamic environment. For your business to be sustainable, you need to have good marketing strategy and you need to have a good brand. Brand brings goodwill to business. It attracts business, to the organization. And organizational design is very important. It shows the structure, the line of authority. The building is not the structure, but the organizational structure itself, how authority and responsibility flow within an organization. Then when we talk about employee and engagement and leading change, we all know leadership is something that is indispensable. A good leader knows how to manage their business. And if someone has quality of a good leadership, either you're a transformational leader, you are an autocratic leader, benevolent leader, whichever approach you adopt, because there is no best one, it will help your business if you know how to manage it effectively. At high performance, at workplace, we need to understand how to motivate and how to get the best out of our employee. All these put together will lead to effective operation. Once you put all this together, lead to effective operation. And once you have effective operation, then you are ready to generate revenue. You are ready to manage your expenses. So now we are now at the stage of how to manage the finance. Now, when we talk about finance, finance is wider than accounting. Finance is a broader aspect. So accounting is just part of the finance, while financial management also goes beyond finance. That's where we talk about how we make decisions as to how what we generate or what we are going to generate will be managed. So here, the knowledge, the knowledge is going to be based on how familiar are you with balance sheets, with profit and loss, and key ratios, and what they tell you, and how you understand what cash flow forecast and why is it important for a growing SME business. I've dealt with a lot of SME in the course of my career. For complete 10 years, I was in charge of so many medium scale business. And because you will see that medium scale business are the engine room of every economy. Okay, so if they are the engine room of every economy, it means they need to be effectively managed. When we talk about balance sheet, what are we talking about? What do we know about it? It's just talking about the asset, the liability, and capital of the business. And that is the totality of what business is all about. When you say you have assets, you have capital, you have liability, we are going to see what is the meaning of that and what is the implication for business. Then the other part is the profit or loss account, which is a situation which is a report that gives us the situation of what happens in the course of a year. But when we talk about ratios is very important. The doctors have stethoscope, which they use to test their patient, but the finance expert, what we use as stethoscope is ratios. We use it to test different aspects of the business. Is the business breathing well? Is it okay? Is it going to survive? So it is the ratios that help us for that. So we are going to look at that. Just relax and enjoy it. Cash flow is an indispensable tool, which help us to manage our liquidity. So just free your mindset, free yourself, allow yourself to be integrated into this module. Some of you may have gotten, residual knowledge, some may have gotten average knowledge, but I'm telling you, you are going to add more today. Okay, so and at the end of this module, there are practice exercise which you can use to, practice more questions on your own. Feel free to get back to us if you have any challenges on them. We will definitely put you through. Okay, so here is what we are going to focus on in this module. We are going to start with the introduction to finance and financial statement. Every business needs to see the picture of their business. And the way you can see the picture of your business or the snapshot of your business, it is through the financial statement. Financial statements tend to bring together all the sections of the business at a go. And before we get to the financial statement, which is a complete document, which I'm going to explain in details later, we are going to also look at the profit and loss account, which is part of the financial statement. Then we're going to talk about break-even analysis. I love break-even analysis because it enables you to know what you are actually walk into. You can make your decision before you go into the business. It tells you how many quantity of product or how many services you are going to render to break even. Because the first thing to think of in business is survival. If you cannot survive in the business, you can't even think of profit. Then we're going to talk about the cash flow management. How do you manage your cash flow? To know when to look for overdraft, to know when to look for leasing. Then the ratios, I've mentioned that, and other key metrics. Then we're going to look at introduction to external finance. How do you get finance? What are the source of financing? Is it equity that is the best? Is it debt? Is it hybrid financing? Is it crowdfunding? We're going to look at that. Then I will signpost you to workbook and supporting materials. Okay, so let's relax and as we start introduction to finance and financial statement. Okay, so the first thing we are going to look at is the business cycle. Because if you are going to talk about financial statements, some of the things that are going to be in financial statement, are concerned with items in the business cycle. When you are to start business, the first thing you think of after your idea, you have an incubator, you are the incubator yourself, you generate the business idea, and the next thing you think of, how am I going to finance this my idea? Because every idea that comes into an entrepreneur's head has to do with solving of problem in the economic environment or business environment. And because you are in the business environment, there are so many factors affecting businesses which are currently in the environment. So you are thinking of, how do I bridge the gap? How do I solve this problem? So you yourself, you are now into problem. You are now facing a problem, and the problem is how to generate capital. So you think of, am I going to go for debt? Am I going to go for equity to start the business? So the first thing is the initial capital, which is the startup. Now, once you get your capital, the next thing you think of, okay, I've gotten the fund I need for the business. How am I going to generate my assets? Am I going to buy them with the capital I have? And how many portion of my capital am I going to invest in the asset? And when we say assets, we have the non-current assets and the current assets. The non-current assets are those ones that are used to generate funds, which are like equipment. We call them property, plant, and equipment. Then after you're able to get that, then you're able to get, if it's a manufacturing, you're able to get your raw materials, which is a current asset. Then you can think of manufacturing. Then after manufacturing, then you can think of sales. Remember, you have done your marketing, you've done your market survey and everything. Then when you think of sales, after sales, then you can now talk about profit. And when you have profit, then you now think of, okay, out of my profit, how much am I going to retain in the business for further expansion? And how much am I going to distribute to the shareholder, who are the provider of the finance? So this is a business cycle, and it go on and on every time. That cycle goes, and they depend on each other. If you don't have capital in form of debt or equity, you won't be able to get assets. If you don't get assets, you may not be able to generate sales. If you don't have sales, you may not be able to generate profit. If there is no profit, then there will be no dividend, there will be no retention for expansion. So it goes together. So as a businessman, you have three areas of financial decision. We call them three areas of decision making. And the first one is financing decision. Which source am I going to use? Why am I using debt? What is the consequence? What are the consequences of using debt? What are the consequences of using equity? You know, what is the expected return the debt provider are expecting, and what is the expected return equity provider are expecting, and what is also the situation of the finance market, which means the capital market. If you are raising funds from the capital market or from crowdfunding, so we're going to look at it. Is it going to be private placement? Then after that, you talk about the investment decision. Which of the alternative am I going to invest? Which of the assets am I going to invest in? How much is going to be for my working capital? Then my working capital, does it have to come from overdraft, or does it have to come from the fund I generated from long term? Then after you are invested in the business, then you generate profits. You now think of dividend decision. The profit I made, am I going to have a constant payout ratio in terms of dividend? Do I want to be paying 50% of my profit as dividend and retain 50%? Or do I want to say a particular fixed dividend every time, and the surplus has to go into retained earning? So all that will be looked into in form of financing decision. Now let's go back to accounting, which is a branch of the finance itself. We have the financial accounting and we have the management accounting. When we talk about the financial accounting, we are talking about, something that is historical in nature. I don't so much like financial accounting. I'm always much in love with management accounting. Why? Financial accounting look at what has happened in the past. But management accounting look at what is going to happen in future. So the financial account perform for the owners. So you are just coming to give accountability because it is a case of stewardship and accountability. As you are aware, in corporate governance, the ownership has to be separated from the control. So those who are in charge of the business, who control the business, either is a family business, either is a self-owned business, you need to separate yourself from the business. So you are a juristic person, you know. Sorry, you are a natural person. Why the business is a juristic person. So you treat the business as an entity and you treat yourself as an entity. So when you are managing the business, at the end of the day, you need to account for the resources you have invested in the business. Even if you are the sole financier of the business, what it means is that you are lending on a long term to the business. And if there are other external investors, it means you have other shareholders who have to receive the report on how the resources are managed. And that is what accounting is doing. So when you prepare accounting, which is the financial statement, you are also going to have some other stakeholders who will be interested in financial accounting. And they include such as the authority, the tax authority, the bank, the lenders, and even the employee are always interested in the financial statement. Why do they want to see it? They want to see the performance and the position of the company over a period of time. And what will reveal that is the balance sheet and the profit or loss account. Those two statements, they are more than that, but those two statements are very vital to stakeholders because the balance sheet shows the kind of asset, the quality of asset, the quality of capital you have, whether you are highly geared or lowly geared. But it looks at it from the perspective of historical event. But when we talk about management accounting, the management accounting is just gathering information for decision making, is for internal purpose, is the internal stakeholders that will make use of that information, such as the departmental managers, the managing directors, and the other directors. They use it to make the decision. It helps them to know how to move the business forward. It is historical in nature. Now, here is an example of a company. Now, if you look at this, we have a company that have a revenue of 121 in year 2020, 135 in 2021. The operating expenses is 83. And at the end of the day, the profit before interest and tax is 38 in 2020 and 34 in 2021. And you just pump in the chat box and tell me whether this business is progressing or not. We can see that there's a growth in the sales. Okay. There is a growth also in the operating expenses. In your own view, on your own opinion, can you type in the chat box if the business is actually doing well, or if you want to say something, you can please unmute yourself and say something. Okay. Please unmute yourself and say something. Or you type in the chat box whether the business is progressing or not. What can you say about the business? Can I hear from anyone?
Yeah, it's increasing its sales, but it's not increasing its profit.
Okay, it's increasing in sales and it's not increasing in profit.
Yeah,
okay,
but increasing is the cost increase. So the marginal cost just increased there.
Okay, that's fine. What can you say about the management of this company? Will you be able to say the company is doing well or it's not doing well? And why is it doing well? Why is it not doing well?
Percentage-wise, still doing well. I wouldn't
Okay.
say it's bad yet. We're still making profit.
Okay, it's still making profit. Okay.
Yeah, but it's a if you look at the management, it should have looked into more into the cost element of it.
Yeah.
The production cost.
Yeah, because if you look at the operating expenses,
Yeah,
it's
that's gone up.
It's increasing. If you look at the sales, it's increasing.
Yeah.
Though the profit
Yeah, profit has increased. So the operating cost increased.
Okay, let me see. There's some things in the chat box. Let me see. Okay, someone said there are some views here. Beautiful one. Okay, so many. Someone says turnover increased, but gross profit reduced. You didn't tell us the implication because here we are trying to make, we are trying to give an opinion on the state of affairs of this company. Let's assume we're in a board meeting now, and we are the shareholders, and the management has presented this to us. Are we going to clap for them? Aaron said profit has decreased as operating expenses has grown. Okay, operating expenses has grown. Mustafa said at revamp upstage in terms of growth. Okay, Channel says the business incur extra costs and reduce profit. Okay, that's very high unnecessary cost. That was true. The cost has become high. Operating cost increase, and more says, I love this person. As Vinicius, I love it. That is what I'm actually want to talk about, which is 11% growth in sales, but 21% increase in cost. That settles it. It means the cost-saving strategy is not as effective as the marketing strategy. Then he said, I will say that the number doesn't say much. It might be that the business invested in something in 2021, so the profit will be bigger in the future. Okay, that's an opinion. That's an opinion because we don't have complete information, but I'm happy you all understand everything. And someone also said, or could be building for the future growth. Yeah, it's possible that in the long run, there is going to be more profit. Maybe because there is much investment in assets and depreciation has increased as a result, the operating cost has astronomically gone up. Brad says it might be a startup business that is looking snowball, therefore pumping profit and cycling further into operating expenses with the view to show bigger growth in the year. So you are all correct, because if you look at it with the information available to us, we will have said, okay, the revenue has actually increased, but when compared to operating costs, it's high. Well, it's possible that they have invested in technology, and when you invest in technology, it's going to be a long-term effect. It's not going to be just something you start cashing on immediately. So you're correct. Thank you for that. That was brilliant. And that was awesome. Okay, so let's go on. So here is what is going to give us the complete picture of everything we need to know about the financial statement. So the financial statement basically is the means through which the management communicates with users of accounting information. And we've seen some of the users of accounting information. The number one is the management, because they need to take decision on the operating activities of the business. We also have the shareholders who wants to evaluate the financial statement to determine the return on their investment. Because when you lay the financial statement, in the front of the shareholders, what they are expecting to see, whether you are going to pay them more dividend or whether you are going to tell them their share price has gone up. That is what they are interested in. Okay, so management will be able to make decision on financial information available, and shareholder will be able to know whether we should still retain this board or not. Then the profit or loss will show the profit for that particular year, and the cash flow shows the movement of cash. Now let's come back to balance sheet. In balance sheet, there are two sides to it. We have the asset side and we have the liability side. On the asset side, we have the non-current assets like the PPE and the current assets. But on the liability side, we have three things which are regarded as liability. And there is a particular one many businessmen doesn't see as a liability, but indirectly is a liability. So we have the current liabilities and we have the long-term liabilities, and we have the equity. The equity itself is a liability, but a very, long-term liability is an undated liability because there is no particular time you are going to repay back the capital invested in the business. But for the long-term liability, those who provide that fund want it in more than a year. So they will fall due after a year. But for the current liability, it will fall due within a year. So your supplier of your materials, if they supply you on credit, they want you to pay within a year. No failure to pay within agreed time will definitely affect the credit rating of the company. But for the profit or loss account, is we are looking at the revenue and we are matching it with the cost, and our decision will have to base on the resultant figure that comes from the addition, which is do we actually have profit or loss, and what is the sustainability of the profit if it is profit. Okay, and if it's a loss, do we have hope that there's going to be profit in the future? That's the way we have discussed about the workout example. Then the next one is the statement of cash flow. The cash flow is very important because it helps business to know when they actually need fund. When you prepare cash flow over like 6 months or 1 year, the cash flow shows you the expected revenue and also show you the expected outflow because it's futuristic. So you are not trying to look, when am I going to have negative? If you're able to spot negative, maybe let's say you start from January and you discover in June, it's a negative net cash flow. So you need to start arranging for finances, either in form of overdraft or in form of loan. Because if you don't, the business may have issue on at that particular period. That is why cash flow is very, very important. It enables you to know even when you make profit, are you even able to pay dividend? Because there is possibility that you have profit and you are not liquid and you could not pay dividend, okay? Because if you pay dividend, you may find it difficult to finance the consumables or the materials that are needed for production. Okay, so here is the key aggregate of the balance sheet. As I've said, we have the non-current asset and current assets. It can also be called tangible and intangible assets. The non-current assets can also be classified into three. When we talk about property, plant, and equipment, is a non-current asset. When it talks about goodwill, especially when a business is acquiring another business. So goodwill is also an intangible asset. Then we also have another tangible asset, which is long-term investment. If you invest in another company, maybe you have a company that is a supplier to you, and for you to be able to take control of that company that supply you the raw materials, you may decide to invest in that company to be able to have significant influence or take control of the business and able to supply the needed raw materials to your company, which now becomes the parent company. I've explained the current and long-term liability. Current are supposed to be settled within a year, like your energy bill that are in arrears, your tax for the year, your supplies that are yet to be paid for. All these are referred to as current liability. But when it comes to loan, either it's a corporate bond, either the loan from the bank, they all fall under long-term liability. The bank overdraft from the bank is under current liability. But the equity portion of the balance sheet is where we talk about the capital that is actually financing the business. That is the portion of the fund provided by the owners of the business, which is the capital contributed. If it's a limited liability company, that is the amount that has been subscribed to the ordinary share. And if it is an undated preference share, which is not actually common, which is the ordinary share that is common, then we have the retained profit. So retained profit plus the share capital is what amounts to equity. So this equity and the liability, when you add them together, they become equals to assets. It means the fund, the owners contributed, and the fund borrowed from the third party are what are financing the assets. For example, a business that just commenced, as owners bringing in £1 million and an overdraft of, let's say, £500,000, and acquire building for £1.2 million, and other raw materials are going to be used for production at £300,000, which means the 1.5 provided by the equity and the liabilities is equals to the asset, which is the non-current asset and the current asset. So when you add the two together equals to this side, then we look at it and say the balance sheet as balanced even before the business commenced. So we are seeing how funds are being used and the source from where we actually receive the fund. Okay. Any question from anyone? Any question? Any clarification? Any question? Okay, so let's go on. So after an hour, I'm going to give us 5 minutes break to stand up, stretch our leg, and take a coffee. That's by 2 o'clock before we go to the next 1 hour. Okay, now let's look at the section 2. We've seen the balance sheet. Now the next one to see is the profit or loss account and break-even analysis. When we get to break-even analysis, I want you to please pay a rapt attention because it's a very important tool. It's not common, it's not pronounced, but it is very, very, useful in business planning. Okay, so here when we talk about profit or loss account, you will say I've been talking about profit or loss account. So what I'm trying to say is that is it that business make a profit or incur a loss? And the profit or loss account statement is a report that shows the summary of business performance over a period of time, and it's usually for a year. But it can be less than a year when a business just commences or when a business is winding up. It can be, or when a business want to show, want to change from one accounting date to the other. So those are the situations when it can change. And that's why we say the profit and loss account for the year ended. For the year ended means at that particular year end. And what does it do? It compares the source of revenue, which is usually sales from sales of product or from the service render, and it is called turnover. And we match it against expenses, and it gives us profit or loss for the year. And what profit or loss does is that is a measure of commercial viability for that particular period. And what is actually telling the users of the accounting information is that, can we sell stuff for more than it costs to produce? So if you can sell more than the cost you are using to produce, then it means you are going to make profit. If you are going to sell less, then it means you are going to incur loss. And that is why I said the break-even analysis is very important, because we are going to match the break-even analysis to profit or loss, because you have to first of all come up with your break-even analysis to know whether you are actually going to make profit. So based on what you are going to get from break-even analysis, you can also prepare a budgeted profit or loss account to know if you are going to make profit. So you know what to do before you actually go into the business. So many businessmen, they don't do the break-even analysis. They prepare the budgeted profit or loss on assumption, and assumption always fail. But when you have the break-even analysis, it shows you facts. It shows you whether your assumptions can actually generate profit or not. So the principle that is actually guiding the profit or loss account is called matching concept or accrual concept. And this matching concept is saying that all the costs incurring in generating the revenue are to be matched against the revenue to what? To arrive at profit or loss for that period. So what it's saying is that if you acquire assets, which is going to last for more than 5 years, you cannot deduct it from the sales in that year. Why? Because that asset is going to serve you for 5 years. So you need to look at the nature of the business. You need to look at the capability of the asset and estimate how is it going to depreciate. You can use reducing balance, you can use straight line balance, straight line method. When we say straight line method, it means the cost will be spread over 5 years equally. If it is £5,000, which means £1,000 every year will be deducted as expenses. It does not involve movement of cash, but that is what the asset is contributing towards the generation of that revenue in that particular year. That is the matching concept guiding the preparation of profit or loss account. Here is an example of a profit or loss account. You can see we have revenue here. The revenue is the income. We have operating expenses. Here it excludes depreciation and amortization. When we talk about depreciation, depreciation is talking about loss in value of a tangible asset. But amortization is talking about impairment on intangible assets. Either you have a trademark, either you have a goodwill. So when they are impaired, it means there is a loss in value of it. So, which means what we have here are the cash operating expenses. So it gives us £400,000. So now the depreciation and amortization, which does not involve cash, is 100. In most cases, banks are always interested in any before interest, tax, and depreciation, because that is the cash that are flowing, and it shows that you are capable of paying back your debt. Okay, so after that, when you deduct it, the non-cash operating expenses, then we have what is called profit before interest and tax. Here, in this case, it is 300. Now, the money borrowed, the interest paid on it for that particular period is the interest that is charged against the profit before interest and tax, which can be called operating profit, which means the debt holder have a stake in the profit or loss account. So the interest paid to them is their stake, and that is why they are interested in the profit or loss count. Then when we talk about after deducting that, then it now comes to profit before tax. Now you pay tax. The government, being a stakeholder, their share of the business is the 50, which is to tax authority. So government is taking their own share for maintaining good business environment. Okay, then you have what is called profit. This profit, which is 100, belongs to the shareholder. And the shareholder can now decide how much portion to be retained in the business and how much to be paid out as dividend. So therefore, the earning before interest, tax, and dividend and depreciation and amortization is a key performance indicator for many businesses. It shows what is going to who. We have seen what is going to government. We have seen what is going to shareholders. We have seen what is invested back in the business in form of retained earning if everything is not paid out as dividend. So that is the purpose of earning before interest and tax. And in most cases, it is used by investor for decision making. So they know that, okay, if we invest in this business, we are able to get profit. And the business have possibility of survival. So those are the purpose of earning before interest and tax, dividend, and amortization. So lenders use it mostly. Banks are not interested in your depreciation because they know it does not involve cash. So as a result, bank doesn't look at profit. Even when you go to them and said, my business is making profit, they are not interested in the profit. They are interested in the cash flow because they believe you can make profit and you may not be able to pay your debt when there is no cash. And that's why they exclude the depreciation, they exclude amortization, and see if you are still going to have positive cash from your trading for that particular year. Okay.
Hey,
so
Mustafa has a question. Go ahead, Mustafa.
Yeah.
Yeah,
Please
sorry,
do.
just before I
Sorry,
get sort of
I didn't notice that. Thanks.
no,
It's
no,
okay.
it's just before I sort of get confused and move on, and then I'm completely lost. So as I understand it, if I'm not mistaken, so the depreciation and amortization charges, so they are essentially estimates of how much you think an asset is contributing to that year's
Yes.
operating expenses. So does that mean that that amount is reduced? So the value of the asset on the balance sheet is reduced by that amount?
Yes.
And then if it is, then why is this considered an expense here?
Okay. Okay.
Which is
So
just
let me
confusing.
explain. Okay. Don't worry, I'm going to break it down now. Now, let's assume a business just acquire a motor vehicle. And that motor vehicle is for the distribution, is for marketing, it's for the distribution of the product, is a van. And you know that the van, you are going to use it for 4 years. Okay, when you acquire it, you will look at it that you have incurred a cost. So it's going to go to the balance sheet as an asset, as a non-current asset. But in that particular year, you must have sat down, the management must have sat down and said that our depreciation policy is to depreciate our motor vehicle over 4 years. It varies from companies to company. Our companies doesn't use assets the same way. So looking at the nature of the business, you believe that, okay, we can use this vehicle for 4 years, and after 4 years, we can sell it for £500. So if you have acquired for £4,500, so how much is the depreciable value? That is 4,000, because you are going to remove the amount you are going to recover at the end of the year. So which means this 4,000, you cannot take it at expenses in only 1 year. You have to spread it over the 4 years. So what it means that at the end of the first year, the 1,000 goes to the profit or loss as part of operating expenses. And this amount will be deducted from the value of the asset, which means at the end of that year, the value of the vehicle will be £3,500. Remember, there's 500 that will be recovered. So the depreciation charge every year will be reducing the value of the asset in the balance sheet every year. So that is the loss in value of that asset. And that is the contribution of it to revenue generation, because it was used to generate revenue for the company in that year. So by the estimate of the directors, they believe it has contributed 1,000 towards the generation of the revenue. Are you clear now?
Yeah, I think that makes sense. So it's almost like on paper, the company is paying in installments when it's already paid up front in cash.
Yes.
But it's essentially an installment from the balance sheet into the expense. Okay, I think I get it.
Yeah.
And that's why it's
So,
an expense.
yeah.
Yep.
So
Got it. Thanks.
Yeah, what the business is saying is that actually we incur the cash in a particular year, but this cost has to be spread, because if you charge everything only in the first year and the asset is still generating for other year, it means you must have overburdened the revenue in that first year and other year. So it will not be, there will be no consistency or equity, and there will be no application of matching concepts.
And is there a legal requirement to do that? As in, even if I knew that I had an asset and I will be, using it over 5 years, is there a legal requirement for me to do this in terms of depreciating the asset, or can I just write it all off in that first year and therefore have a big loss in that first year, if you like?
Yeah. In this case, in the case of depreciation is a policy issue. There is not even accounting standard that says this is the amount you must charge as depreciation. That's why we call it policy. That is, the director comes in and sit down. It's not even the managing director. It's going to be the policy of the organization that this asset, based on our business, this is how much year is going to last. So they agree, not based on a particular purchase, but based on policy. So in the financial statement, there is a section that is called Smith Statement of Accounting Policy. So there is going to be a policy that has been formulated. So when any asset is acquired, they fall into each of those categories. And it is based, it is at the discretion of the directors. The directors formulate it. Just as we have said, a director can say, because of the nature of our business, we can't use this asset more than 2 years, but we feel we can charge everything for first year. So what it means is that they believe that nature of their business means they should write it off the first year. And even if they are using it in the subsequent year, there will be no more depreciation on that particular asset because depreciation has been exhausted in the first year.
But I guess you'd want to smooth it out so that for tax purposes, you're reducing your tax burden is the main.
Okay, let me now explain to you. You know, it doesn't have effect on tax purposes. Why? Because it is based on your policy, but there is a standard from tax office. The tax office has their own scale. We know you have acquired vehicle. There's what we call capital allowances, which is granted in lieu of depreciation. So depreciation will be disallowed by tax authority and it will be replaced by capital allowance. So they have standard for granting you allowance for purchasing those vehicles for your operating expenses.
Okay, yeah, no, that makes sense. Yeah, no, that makes sense. Okay.
So that everybody can have a uniform allowance for the purchase of a particular asset. That is the essence of that. Okay.
Perfect. Yeah, no, I think that makes sense. Thank you.
Thank you very much for that question. I'm sure it must have enlightened some other people more. Okay, now let's come to the cost behavior. Now, you know, the cost behave in certain manner in an organization because this is what is going to lead us to the break-even. Most of the costs we incur can either be total fixed cost or variable cost when we look at production or in rendering services. Now, those costs that does not change, you know, we've talked about operating costs. Some of these operating costs internally, not under financial accounting, but under management accounting or cost accounting, you know, which is for internal purpose. Some of them are fixed costs, some of them are variable costs. The one we regard as fixed costs are those costs that does not change regardless of the level of our activity or the level of output. So example of such cost is if there is a manufacturing company and they acquire a factory building. So the number of units they produce doesn't change the cost or the rent of that building. So the rent still remains the same within a particular relevance, range. So if they're producing 20, they still pay the same rent. They produce 100, they still pay the same rent. But the cost of material that are actually using in producing that particular product, let's assume they are producing pen. So the plastic for the pen, the rubber for the cover, all those ones are going to be variable cost. The labor, the direct labor that produces, they are going to be variable cost. Why? The more pen that are produced, the more plastic that will be consumed, the more rubber that will be consumed, and the more amount that will be paid to the labor that are directly involved in the production. But the supervisor, the admin salary, those ones will form fixed cost because they are not related to the quantity of output. And that's why we said total cost can either be segregated into fixed and variable cost. That is why you will see the line of fixed cost remain straight. The y-axis represents the cost and the horizontal axis represent the output. So here you produce 10 is the same thing, you produce 20 is the same thing. But for variable cost, the more you produce, the more is going up. You produce 20, each one is 10, that's 20 pounds. 20 pounds. You produce 40, that's 40 pounds. So you continue to increase because as the output increase, it also increases. So those who are in manufacturing, those who are in production, those who are in service, this cost behavior are very important to them. Unlike when we look at financial accounting, where we just take the cost because they are historical. Okay, so here is now the break even. Those two cost elements were brought in to this to show the relationship between the cost and the sales revenue. That's why they're here. Hold on, I can see. Okay, so you can see here. Here is the fixed cost. The diagram of the fixed cost we saw on the last page. This is the axis, and this is that fixed cost. Then the variable cost is this. So from here to here represents the total cost. And here, when you see what we do here is to say this is what variable cost will be in isolation. This is what fixed cost will be in isolation. Then when we add the two together, it means the variable cost will start from where fixed cost end and it will continue to increase based on the quantity. So what it means is that if I produce 10, my fixed cost will remain the same. Here will be my variable cost. Then if I produce 20, I move forward, my fixed cost will be here and my variable cost will be from here to here to go up. Therefore, my total cost is from the origin to here, which comprises of both fixed and variable elements. So from here down here is the fixed cost. So what I'm trying to say is that if I rent a building and I know my staff salary who are admin is 50,000. So from here to here is 50,000 at this point. Then the variable cost of production in terms of direct material and direct labor will start to vary. So I will start increasing it based on the level of production and it continue to go up. So my total cost will start increasing. However, I will have to now plot my sales. If I sell nothing, I will be zero. So the sales will also have to start from zero. So the more I sell, the more the sales is going up. The more the quantity sold, the more the sales revenue. So at this point, if you look at it here, if I sell less, it means the total cost will be above the sales. So here is my loss region. And after the loss region, here comes the break-even point. The point at which my sales revenue is equals to total cost. My sales revenue is equals to total cost. So once I'm able to cross the break-even point and my sales goes above the total cost, then I'm already on the profit region. So after the break-even is the profit region, below the break-even is the loss region. So that will enable me to know how many units am I going to sell to break even? How many units am I going to sell to make profit? And how many units am I selling that will lead to, to loss in the operation? So this break-even analysis helps us to plan. Then to get the break-even is just to say, okay, I need to be able to break even, I need to cover my fixed cost. So it's going to be fixed cost divided by the contribution. So what is contribution? Contribution means the sales per unit minus the variable cost per unit. That gives us the contribution. And when we say variable cost per unit, we are looking at the direct material, the direct labor, and other variable overhead, like the case of plastic, which I use as an example. So this map helps you a lot. So from this break-even point to the targeted sales, it is regarded as margin of safety. So once you move from break-even up to the maximum you can sell, you are in a safety zone. You are in a secure zone. But below it is a loss region. So if you continue to stay within the loss region, there is possibility that the going concern of the business will be threatening. Okay.
Ayo, we just got a question from Erin in there. Should the profit area label be above the total cost line?
Yes, the profit area is above the total cost line. Here, this particular region is the profit region. And below
the total cost line.
And the below where the total cost is above the sales, that's the loss region. So when the cost line is above the sales, it's loss. When the sales is above the total cost, is profit. But where they intercept is no profit, no loss. You are just surviving. Is that clear now? Okay. Let me see the chat box. Any other question before we go on the 5 minutes chat break?
No questions. Courtney's just left us because he has another meeting. And Adam is just joining us in time for a break. So it's a perfect time to have a 5-minute break. Adam, you've joined us just in time to have, he hasn't joined yet, but I'll let him know. Okay, so
So,
if everyone could be back at 10 past. Adam, you've joined us just in time to have a break. So see you in 6 minutes.
yeah, that's great. Thank
Thanks,
you,
everyone.
Jessica. Thank you. Okay, I want to welcome everybody back. Okay, I want to welcome everybody back. So let's continue. Are we there?
Yeah, we're
Yeah, welcome back. I hope you enjoy your coffee break and you have taken cookies and you have not started applying the accounting on the cookies. Not your time. Okay, so we've talked about the break-even and we have seen the relationship between the cost and the revenue. We've seen the relationship between the variable cost and fixed cost. We've seen how costs behave. Some are just, stable, continue to be permanent, while some varies. And the understanding we need from this break-even analysis is that it enables us to know how many units are we going to sell to break-even point. And from there, we can also know it in value by multiplying it with selling price per unit after getting the breaking even in sales. So the formula for it, or the simple arithmetic, is just the fixed cost divided by contribution. A sale contribution is selling price minus the variable cost per unit. Now, this is for planning. If someone is coming to present and say, let's go into this production, either you are presenting to management or to family member who are board members of the company, you will use this graph to show them. And this will be easily understandable by even a non-accountant. See, this is what we are going to say. This is the cost. This is how I go above it. With that, the person will be able to comprehend. Now, let's look at this example. Can anyone tell me or put it in the chat box what is going to be the break-even in units? Since we have said the break-even is fixed cost divided by contribution, and contribution is the selling price minus variable cost. Here we have fixed cost per month as the 20,000. Each basket require cost £2 and takes 30 minutes to make. Basket maker are paid £12 per hour and are on contract such that if they do not work, they are not paid. So which means here we have the cost of material and the cost of labor. But remember, per hour is £12. So which means how much is going to be to produce a basket, which is 30 minutes. So which means we have 6. So can someone tell me what is going to be the contribution? Just type in the chat box, what's going to be the contribution? Type in the chat box or you unmute yourself and just speak. You can unmute yourself and speak and tell me the contribution. Anyone? Okay, any question in the chat box? Anyone? We have Adam. Can Adam tell me? Alan. Can Alan tell me? Chantal, Mustafa, Elad. Can anyone tell me? Anyone? Okay, someone has pumping something in the chat box. Oh, someone said I just backed now. Oh, Vinicius. Okay, so let me help out. Okay, someone is speaking.
Yeah, I just didn't understand the contribution of what?
Yeah, once the contribution is like a profit, but not really profit. Contribution is the difference between the selling price and variable cost. So what is the variable cost of producing this basket in the first place?
£2.
I was going to say, is the contribution about 12,000? So each basket costs about £8 to make, because takes 30 minutes, which is about £6 plus £8.
Yeah, that's good.
Oh,
To
yeah.
produce a basket is 6 plus 2, because the material is 2 and the labor is 6. That's 8. Now to not get the contribution per unit, you need to deduct that. You need to deduct that £8 from the selling price. The selling price is 24, which means 24 minus 8 that gives us 12. So the contribution is 12. And for us to be able to get the break-even in unit, it's now going to be the fixed cost divided by the 12, which means the 20,000 fixed cost divided by 12. So when we divide 12 by 20,000, that gives us the break-even point, which means that is the number of units we are going to sell without making profit and incurring loss. But the company, the maximum they can sell in a month is 12,000. If we are estimating it based on months, so we can see here that the variable cost is £8. The contribution, sorry, I mean 16, not 12. 24 minus 8, that's 16. Okay. And the maximum they can sell is what? Is 2,000. But to break even, they need to sell 1,250, which means 20,000 divided by 16. If they sell 1,200, they are going to incur loss. They are not going to make profit. So they need to sell minimum of 1,250. So in the process of developing business plan, we have now to check, can the marketing units make the sales of 1,250 units? If they can, which means we can break even. If they can sell more, that's good luck. We can now even make profit. So we know the point of survival and we know the point of profit making. That is the essence of break even. So with this simple calculation, we can always know how many we can sell. And how do we generate how many we can sell? We have to look at the possibility of sales. We have to look at the competitors. We have to look at other factors within the business community. How many people, how many customers are we sure we can get? Okay, that's good. So here is the plan, is the expected profit. Now, if they are going to sell 2,000, this is the resultant profit. If they're going to sell at break even where there will be no profit or loss, which means when they're selling 2,024 per unit times 2,000, that's 48,000. But for the break even is 1,250 times 24, that's 30,000. The variable cost, which varies with the level of production, is 8 times 2,000, that's 16,000. And here, 1,250 times 8, that's 10,000. And the fixed cost, either they sell 2,000 or they sell 1,250, is going to remain at 20,000. Because, for example, the rent of the office is not going to change. The salary of the manager is not going to change. So they remain constant. So here, if they're able to get the maximum, they sell 12,000. If they're able to break even, they get nothing, they still survive. That is the importance of break-even analysis. Okay, now, any question on break-even within 1 minute so that we can go to cash flow? Any question on that? Okay, thank you, Hugh. I can see some people are pumping the answer on break-even. That was brilliant. Thank you very much. That was great. I'm happy you understand everything. Okay, so here what talks about cash flow management. When you prepare a business plan, most of these items are what makes up the business plan. Either you are interpreting or you are analyzing the business plan that you paid for, or you are even trying to make the business plan by yourself. You need to understand what is in the business plan before you start implementing the business plan. So here we're going to be looking at cash flow management, because cash is very important to business, just as blood is important to human system. Where there is cash crunch, there will always be problem in the business. So that is why cash flow management is very important. Now, if you look, who can tell me what percentage of first small business collapse due to cash problem? In UK, for example, in UK, don't Google it, just give me what you think it is without googling it. You can tell me. I see someone pumping in the answer, 56, 82, C, 60. Okay, we have mixed answer, but 82 seems to be leading. Okay, based on the data we have from this, response, I think the highest number have it. It is 82%. So 82% of business collapse through cash crisis. Not even because they're not making profit, but because of cash crisis. And that is why there is need for cash planning. Because when you cannot pay your supplier, you're in trouble. When you cannot pay your staff, you're in trouble. When you cannot pay for your rent, you are in trouble. You must be able to meet business expenses before business can able to make profit further and survive. Okay, so cash flow forecast is used to estimate the cash that are coming in and the cash that are going out. And what we're saying is that items that does not involve cash doesn't come into this cash flow. For example, items such as depreciation is not going to appear in the cash flow because it does not involve cash. So example of cash flow are cash from sales or the capital injected by the owners of the business or the loan from the bank is a liability, but it's coming in as a cash. Okay, cash from customer, those who have who has acquired product on credit, when they pay, cash flow in from them. So we have various ways in which cash can flow in. Even when the asset of the organization is disposed of, then there can be cash inflow as a result of disposal of the asset. Then we have the expected cash outflow. That's cash payment made on purchases for inventory, the salary payment, the utilities such as energy, such as electricity, broadband for the organization, and other expenditure. So in the case of cash flow, there's no separation between capital expenditure and recurrent expenditure. All we are looking at, does it involve cash? It doesn't matter when the transaction is going to happen. When did the cash actually flow? I'm paying my rent in January, but the rent is not due until October. I'm not going to record it in October. I'm going to record it in January in cash flow because that is when it actually flows out. I'm paying for 2 years rent and I'm in the first year. In the case of profit or loss, it's only 1 year I'm going to put, but in the cash flow, I'm going to put the total in the month I actually pay the cash. So cash flow is looking at when did the payment arise? When did the cash flow into the organization? That's all. And when, what is the balance at the end of each month? Is it positive? Is it negative? So I'm able to see in advance that in August, I'm going to be having a negative cash flow. So I start talking to my bank, I start arranging loan or bank overdraft. That is what we call cash flow forecast and cash flow management. Okay, so we can see example is always ideal to produce it on monthly basis. Some can produce it on quarterly basis, but the ideal one is monthly basis. And here is showing at, we have cash flow. At the beginning, they have 100, and there's additional cash flow of 50, and there's cash flow of 70. So at the end of month 1, there is net cash flow of 80, which is positive, which is going to be the opening for month 2. Then what is the inflow in month 2? 70, and what is the outflow? 60. So that gives us positive net at the end of the month, which is going to be the opening in the following month. So this will always accompany business plan or feasibility study. We always have this in it. So what it shows is cash at the beginning of the period, cash that comes in, cash that go out, and the net cash at the end of the particular month, and it's going to be the opening for the next month. So we need to pay attention to cash flow for our business if we want our business to continue to survive rather than paying all attention to profit. So here we talks about the working capital cycle. The working capital cycle always affects the way our cash flow within the organization and in terms of meeting the expenses on day-to-day basis. So we have the cash flow, we start from when you buy your inventory, when you sell, either you sell on credit or on cash. If you sell on cash, cash comes in immediately. But when you buy and you sell on credit, how long does it take for you to convert the cash into, credit sales? And when it comes to credit also, when it is in stock, it's a positive. When it is in receivable, it's a positive. But when it becomes payable, it's a negative. So that gives you the number of days it's going to take to turn your, your capital around. So working capital is the net investment in the inventory, receivables compare with the payables under current liability. So what we are trying to do is to deduct the current liability from current assets. So when you deduct current liability from current assets, it gives you the working capital. So it shows you whether you have a positive working capital or negative working capital. If there is a negative working capital, there is going to be liquidity problem. It means your current assets are not able to meet your current liability, and that is not healthy for business. Okay, so here is an example of element of working capital in the balance sheet. Here we have cash, receivable, inventories, and this is the net fixed assets. Here is the current asset. So we have the current asset plus the fixed asset. That gives us 1,100 in 2021, and in 2020 it was 1,210. Then for liability, here we have the short-term debt and the account payable. So the two form current liability. Then we have long-term debt, which are the liability that are going to be settled at a very longer period. Then we have owner's equity, which is what is contributed by the owners of the business. So this is what comes from the finance source. We call it external sources. We can see the equity here, which is the amount contributed by the owners, because the business is different from the owners. Whatever comes from the owner is assumed is coming from external sources into the business. And this is what they have used the fund to do. And we can see here that we have the element of current assets and fixed assets. We have elements of short-term liability, long-term liability, and capital. So this side is liability side, the above is the asset side of the balance sheet. Okay, so here is how we measure the working capital. We measure them in days. Here, this is telling us how long it takes us to hold inventory. For us to know how long it takes us to hold inventory, we look at the average inventory over the turnover. So how long does it take for you to sell your inventory? So in this case, it takes them they hold the inventory for 45 days, after which they sell, and it takes them 50 days to receive the capital, to receive the amount sold on credit. So they hold it for 35 days, it was sold, and it takes them 50 days to collect the funds back from the customer, and also takes them 45 days to pay their creditors. So it takes them a longer hour to collect than to pay. So which means averagely when they sell on credit, it is after 50 days they get the money. But for the suppliers, it takes them 45 days to pay them. And for inventory, when they acquire it, it takes them 35 days to what? To sell after the acquisition. We are going to see how to estimate all that in the ratios because of our time. Okay, so here are the cash flow concern. As I've said, what the business owner need to be concerned about is how can I better manage my cash flows? By preparing your cash flows forecast, I know when did I actually have negative? When am I having surplus? Having too much surplus is not good for business. Instead of tying it down, it's better to invest it in a fund that are risk-free, maybe buying treasury bill and generate a little interest for where those periods the cash are not useful, rather than just tucking it in the bank and not receiving anything. So it's not good to have idle cash, and it's not good to have negatives. Then the next question is, what is the judgment, the strategy, or the tactics of leadership? That is for business management. And here we are looking at good information to get from staff. This has to do with efficiency of the business. So you have to ask questions. You must get in a good report from your employee. You must see how often they manage their petty cash, so you don't have too much cash in the hand of the petty cashier. So you must estimate how much they actually need, so they don't run out of cash for petty expenses. Okay, now let's look at the ratios. I hope there is no question on the cash flow. Any question from anyone on cash flow? Feel free to ask. This is business clinic, not just an ordinary lecture. So feel free to ask anything. Okay. Okay, no one. Okay, so let's move on. We're almost there. Well, here is our stethoscope. As an
Sorry,
accountant.
Ayo. We've got a question from Hawaii. Isn't there a liquidity issue if you don't have enough cash?
Yeah, that is what I've just said. When there is no cash, there are issues, because you will not have cash to meet your day-to-day operating expenses, as that when you have negative. So the reason for preparing the cash flow in the first place is to avoid cash crunch. It does not mean that you are not making profit, but when there is no cash, everything stands still. If you don't plan your cash, you may be expecting a fund and the fund may not arrive and you need to pay your staff. If you don't pay your staff, that is problem. If you don't pay your supplier, that is problem. So the lack of proper liquidity planning is a serious issue, more serious than when a company is even making loss. And that's why at the beginning, we discovered that 82% of businesses fail as a result of cash issue. Okay.
No,
Chloe,
so I don't think I explained my question properly. So earlier you mentioned that if you have too much cash, you need to think about where to invest your money. But what's that threshold? Because don't you need something for a rainy day? Like you might think, oh yeah, we have a surplus, so we should put away. But then you never know if something happens, like a pandemic, for example. Then if you put your money away in the 4-year bond, then you're a bit screwed essentially.
Okay. Yeah, thank you. Remember what I said? I said, if you have surplus cash, you have to put it, if it's for operation, you can't put it in bond, because bond is a long term. You can put it in treasury bill. Treasury bill are very fast, and you can also make it just a fixed deposit, which we can easily break. The interest, the more liquid it is, the lower the interest. But you are not concerned about the higher interest. You are just concerned about let the cash bring in something. So that's why you have to think of what is the quantity of cash that is surplus. So you go for treasury bill, which is a short term, like 3 months, and you can always roll over, or you go for fixed deposit in a bank, which is higher than just leaving your money in the current account of the business. So that is what I'm trying to explain. Exactly. Are you convinced with that? Are you convinced?
I mean, yes and no, but that's fine. I understand what you're saying, but yes.
Yeah, I understand, because it depends on the situation of the company. It depends on the situation, and depends on how much the company is going to need in the future and how much is available as surplus. Okay, thank you. So in this case, we are looking at the ratio analysis, which is the stethoscope of the financial expert. This is what every financial expert used to test different aspects of the company. It is techniques for evaluating the stability and the growth of the business. Ratio can be compared either with the budget. We have set target. This is the percentage of return I'm expecting, and you'll be able to compare what you have set as a target and what you are actually getting. So it's mostly for internal use when it is budget. It can also be compared over the period of time, or compare with competitors. What is my competitors getting based on their financials? And the industrial average, you can compare your ratios with industrial average. So when you have a ratios, it must be compared with something. It's just like someone who is checking his BP. You are checking your BP against the standard. The standard says it should be 120/95, and you are having 140/110. There is a problem, because how do you know there's a problem? Because you are checking it with a normal blood pressure. So the same thing, organization has their own blood pressure, which we are checking to see whether they are actually doing well or they are on, on the danger path. Who are the users of these ratios? The existing and potential lenders, they use the financial information to assess lending risk, and they always pay attention to the gearing in terms of ratios. And we also have the existing and potential creditors. They want to see the current ratios. Are you able to pay back? What is the ratio of your current asset to your current liability? If we demand for our fund, or if you buy on credit, are you able to pay or not? Those are the reasons why they need the ratios. So we can see the ratios is basically classified into four. We have profitability ratios. An example of profitability ratios is operating profit margin. We also have gross profit margin. We have return on capital employed. All these are measuring the profitability of the business. So, and they are measuring it in relation to revenue. So, which means what is the ratio of my operating profit to revenue? So if I'm able to get 50, for example, it means for every 100 pounds, I'm going to make operating profit of 50 pounds. That's the meaning. For if it is gross profit, if it is gross profit over revenue, if it's 30, it means for every 100 pounds, I'm going to get 30 pounds. If I make sales of £1, I'm going to get gross profit of 30p. So that is the meaning. That's why we call it profitability ratio. So we are using it to check whether we are making profit. But if what we get at the end is loss, it means we're having negative, which will be compared to the target. So we're able to measure, is the business progressing or is it retrogressive? So that will help us to evaluate the profitability of the business. And based on that, the management will be able to take appropriate action, either to look into the cost of production or operating expenses. But here, when we talk about efficiency, example is sales per employee. We also look at the case of, debtors collection day. How long does it take to collect the debt, or creditors payment day? So in that case, if it is debtors collection day, for example, they're going to say receivable divided by the credit sales, and if every sales is on credit, just say receivable divided by sales times 365 days to show how long it takes us to collect the debt. And compared to what we have mapped out, we have said it's going to take us 20 days to collect the debt, but based on our financial statement, it shows that it takes us 40 days to collect the debt. So we need to come up with a good debt collection strategy. Either we offer, if you pay within so, you'll be entitled to a particular rebate. If you pay within so, you're entitled to a particular percentage of cashback. So those are the ways to come in to manage the efficiency ratio. But when it talks about liquidity ratio, we are actually looking at the short term. So here we have quick ratio, which can also be called the acid test ratio, where we talk about current versus current. So that will tell us how fast, how can we meet up the immediate obligation, which are falling due within a year. So the supplier are always interested in this. But when a supplier discovers that your current liability is more than your current asset, they will be reluctant in selling to you on credit because they are not sure you'll be able to pay back conveniently. And it costs money to collect debt from those who does not have capability. Okay, then if it is just the current asset over current liabilities, then we're just talking about just current ratios. So in this case, the industrial norms, there is no standard for industry, but people always say ratio 1:1 is good to quick ratio, while ratio 2:1 is good for the current ratio without removing the stock. So there is no standard, but depend on the industry and the organization. And here we are looking at the gearing ratio, which look at how the organization is being financed, looking at the ratio of debt to the capital employed. The capital employed in the business, as we have seen at the beginning, is the debt and the equity. And equity is the capital plus reserves. So here we're looking at what is the ratio of debt to the entire capital. If the debt becomes 60%, it means the company is highly geared. Highly geared means that the company is on danger zone, which means too much debt is financing the business. Any attempt for the debt holder to pull back their debt, it may lead to collapse of the business. So company need to be moderately geared instead of being highly geared. And it is not good for company to be lowly geared. It means the company is not taking advantage of the fund available, provided they can put it into effective use. So gearing is just telling us, the percentage of the component of the capital in terms of debt, in terms of equity. Another stability ratio is the interest cover. So where we look at the ratio of operating profit to the interest. So how many times can the operating profit cover the interest? The more the number of times of cover, the better for the business. Okay, then we also have the one that is not shown here, which is for shareholders. No, shareholders look at earning per share, dividend per share. They're checking it over the years. Are they growing or are they retrogressive? So depend on the area we're looking at. So most of these ratios have formulas which we are going to see towards the end of the class, as I've shown some of them. So we can see here for this company A operating profit margin is 10.3 and company B is 8.5. So in terms of profitability, company A is doing better than B. Sales per employee, in terms of selling per employee, company B is doing better than company A. In terms of liquidity, company B has capability to pay the current liability more than company A because this is 0.7. This is poor because it's less than 1. So in terms of gearing, we can see for company A is 42, which is okay. It's not even up to 50%. It's moderately geared. But if you say company B is 65.1%, that means the company is highly geared. So they have different metrics where they're better than each other. So we look at profitability, we look at efficiency, we look at liquidity, and we look at gearing in terms of operation. So they have area where they are better than each other. And no ratios, is more superior to the other, depends on the area we are looking at it from and depend on the plan of the organization. Here is the dashboard that shows the financial metrics. The dashboard helps organization to look at trend of what happened. So when we compute the ratios over the year, then we can put it in form of trend. Either we represent it in form of the graphs, in form of line graphs, and show it. So at a glance, we can see that the company is actually progressing or is not progressing. So ratios are the way to populate the metrics for the dashboard. So ratio helps us to populate. So whatever we compute is what we are bringing into the financial metrics. Okay, here we look at the balance scorecard. For balance scorecard, we look at the area of finance, generation of capital. We look at the internal process of the organization. We have to have financial strategy, internal strategy for operation, the learning and growth. How do we train our staff? How do we grow our business? How do we get the right capital? Then with that, we should be able to also satisfy our customer. And when we satisfy our customer, we make profit. So that is area of balance scorecard. We look at different sections of the business. So on the balance scorecard, in the financial area, we'll be thinking of how do we lower operation costs through efficient process and improving the skill of employee. How do we increase profit? The lowering of costs will lead to increase of profit. Increase in revenue will also lead to increase in profit. And also, the faster efficiency will lead to faster output. Then lowering the waiting time will lead to retention of customer, because when customer comes and you don't waste their time, they tend to come back again. Then when the is efficiency, you have cut away waste, you've bring in quality control, then you have a faster output. Then when you improve the skill of the employee and provide the necessary tools for them to work, it will also increase the efficiency in terms of production. So in conclusion, metrics are only useful if they can be compared with other, period, that's the trend over the years, or you are comparing with competitors or industrial benchmark, or business need to adopt what? A good layout of metrics, which reveal what the organization actually need through the dashboard. Okay, so we need to make use of these metrics. Then option for finance. When we talk about finance, this area is very important. A good business may not survive because of the wrong source of financing. So an organization needs to think of the best finance to finance its business. There's some business, it is good to use equity, which means every risk will be on the owners of the business. But there are some that need an hybrid where you have debt and equity. In that case, you are trying to share risk. However, the cost of debt is usually cheaper than the cost of equity. When you take debt, it means you are looking for a cheaper fund. But when you look for equity, the equity provider are always looking for higher return than the debt financing. But however, the debt should not be too much than the equity, because it may be risky, as most of the profit generated will be used to finance the debt. There are also other alternative sources of finance like crowdfunding, like leasing, which is an off-balance sheet financing. So if we look at this, we will see various means of external finance. We have angel, which is related to different forms of business. We have venture capitalists, where different people come together to operate a business, and at the end of that particular venture, everybody goes their way. We have corporate venture capitalists. We have private equity, which we call private placement. We have initial public offer, where a private business decides to say, I'm going to the public. I want members of the public to invest in my company, and I will still retain controlling share. So we have initial public offer for that. And a public offering is company that is already on the stock exchange, but now selling its shares to the member of the public again. Then there can be a startup loan, just as we have in Scotland. When people start, they give you startup capital in form of soft loan. There can be overdraft in the bank. There's bond, which is corporate bond. But if it's government, it's called government bond. There is also corporate bond, which is in form of debenture. There's peer-to-peer lending. There's asset-based finance, which is like leasing. There's leasing and hire purchase. These are various ways in which organization can finance its business. This is the equity portion. In this one, they share profit, but all this one below, which are debt option, they get interest, So, but debt can be cheaper, depend on the state of the organization and the state of the capital market or the economy. If the capital market is bearish, it will be difficult to raise equity from the capital market, either through venture capitalists or IPO or private placement, because there'll be cash crunch. But going to the bank also has its own risk. There will be a lot of analysis. If the company is already highly geared, it may be difficult to obtain further loan, because when they analyze the financial statement, they discover that the company is already highly geared. So it may be difficult to obtain additional debt capital to finance the business. So depend on the state of the business. So can you tell us more about growth finance? I don't understand. Can you please unmute yourself? Growth finance in which area? Someone asked the question.
Okay. I was asking regarding the last point on debt options.
Okay.
Like what in particular makes growth finance different to the rest of the debt options in that list?
Sure. Okay. You mean all this debt option? What are the growth finance? No, the growth finance is a debt option, because what you do here is that you are doing crowdfunding. You are asking people to bring in funds from different areas, and you are growing the fund. Just like I want to set up business, I have people come and invest, and they come in like it's more in agriculture. I've seen it more in agriculture where someone decides to buy land and ask people, okay, I have a land, you can come and take the portion of this land, bring your money. We call it crowd farming. So you bring the money, they manage it. You don't actually own a shares, but you own portion of the business. That is what is meant by growth finance. So it's an example of crowdfunding. Okay.
Thank you.
You're welcome. Okay, so credit score, for you to be able to raise finance, you need to have good credit score as a business and also as a director, because your lifestyle will also affect your business if it's an entrepreneur or a one-man business. So we need to have good credit score, and the reason is that it impacts amount of credit available to company. If it's a company that has always been defaulting and the credit check does not speak well or is not positive, then it will impact further supply to them. So an organization needs to ensure they have good credit rating, and we have a lot of them. We have Experian, Equifax, Credit Safe, which can do credit check on company. Okay, so in summary, we've been able to cover some. It may not be as we wish to be able to ask more questions, but I believe we will have 2 minutes or more to ask questions. So remember, there is a workbook. Go to the workbook, practice the question. Our email is online. If you need any further clarification, feel free, to send email to us. We will definitely, be there to support you, not just to deliver the lecture, but to also support you after the class. You can be sure we have all the resources that can make you, the business you want to be, and also, we can help you to grow as you want. Thank you very much. Any question? Any question from anyone? I decided to retain a few minutes so that I can ask questions.
I just wanted to say thank you for taking us through this journey. Although I've studied AAT, but this has been a refresher because you learn a lot of material during your studies, but you don't really use much because depending on the business, what area of the finance and accounting you are using. But this has been a very refresher and also a reminder, something that I've really totally forgotten about. So thank you.
Thank you very much. It was also interesting that I'm also an AAT, because that's where you actually learn the rudiment of accounting. I'm also an AAT. Thanks. Okay, Adam, I can say not for me. Thanks for the session. It's for everybody. You don't need to practice all this. You are a businessman. They are going to drop it on your table. Then you have to make sense out of it. So it is time to start take charge instead of, no, please, accountant, please go and do the writing. I just want to sign the check. And I just want to make decision. So please be interested in it. It's for everybody, but you don't need to worry yourself on preparation of financial statement, development of the break-even. All you need is just the knowledge. Tell me what it's all about. And with that, with this knowledge, you will be able to ask questions. When you don't ask questions, they feel everything they give to you is okay. Then you have to take it. But when you ask questions, I understand you'll be able to make sense out of it. So please, I don't be concerned. Okay, Elad, thank you very much. Any other question from anyone? Ask question, even from your business. You don't need to tell us about your business. If there's anything that you're concerned about, we are here. This is a clinic. You can get it free of charge now, and this is an opportunity to get free services.
I'll ask a question.
Yeah,
so it was a really good session. Thank you very much. My question is, where do you suggest, I can get a good finance advisor or an accountant? Because I had an accountant. Unfortunately, he passed away. But but basically, I think I definitely need more guidance than just someone that do the accounts and submit the company's report or whatever. So there's anywhere I can find someone, or if you know someone, that would be interesting.
What I would say is that, UWS has been producing fantastic graduates. During our graduation, you can come to the school, you can talk to Jessica, they will link you up. We have brilliant students. We have people who have come to add on our students even before coming up, because we expose them to practical situation. And also, if you want to do interview, I'm sure F to Grow can also conduct interview in conjunction with your team of experts. Okay, we have a lot of accountants, brilliant accountants across UK. UK produce the best accountants in the world. I must tell you the truth.
Okay. So Shanu has offered some help there, Vinicius, as well. But yeah, as Ayo said, we have quite a few accountants within the Trampery membership as well. So I'm more than happy to, if you want to send me through some details of what you're looking for, I'd be more than happy to do a call out for you. We have another question from Abdul. What is the simple way to get banks to give you a loan?
What? I can't see the question. Is it typed?
It is typed. What is the simple way to get banks to give you a loan? I'm just reposting it now.
Okay, maybe send direct to you. Okay, the best way to get a loan is to ensure, you see, the bank, getting something from the bank, you may feel my business is okay, I'm making profit, is to have good accounting system. That's number one. Have your financials ready and your cash flows. So you may not be making profit, because if your business is doing well, you don't need help. You only need help when your business is not doing well. But what the banks wants to see, right now my business is not doing well because I'm not liquid enough. Now, you prepare a good cash flow that shows the revenue and shows the outflows. The reason why I'm having a shortage is because at a particular time, I need to meet these expenses. I need to generate this revenue, but I cannot meet these expenses because I don't have enough cash. And as a result, I cannot generate a good revenue. So you need a good cash flow, which you can defend, because the cash flow that we prepare will be subjected to sensitivity analysis. What do I mean by that? They will have a certain metrics in the bank where they use to see, you have said, my sales is going to be £100. Okay, if the sales is not £100, if it goes down, looking at the economic situation, if it goes down to 60, will this business still be viable? So that is what they want to see, the margin of safety. So the first thing you do is to ensure you have good financials and you have good cash flow. That you have to, cash flow is what you use to convince that, yes, I am capable of paying back. And the source has to be credible. If you are saying you are going to sell 100, is it actually possible for you to sell 100? If it's not possible to sell 100, the bank would discount it without telling you. It will be discounted. And when it's discounted and it comes to negative, no one is going to give you, because it's other people's fund. The fund does not belong to the bank. It belongs to other people. So they need to protect the fund of other people. So that is why you need to have a good cash flow which match your accounting. So not profit, but some people think my business show profit. Banks are not interested in the profit. They are interested in the liquidity. What did you need cash for? And how do you intend to get it back? Are you able to generate the cash to pay back and still operate your business? So what you need is cash flow, effective cash flow, and should be realistic.
One of the difficulties of startup business is the finance, and there isn't great facilities for startup business tapping into cash capital?
Yeah, you see, when you want to start business, okay, the best way to be able to get finance is to first of all get the owners of the business to have stake in it. Some people want to start business without having a stake in it. If you're starting business and you just want to start with bank loan, it will be difficult. You need to have a stake in the business. You can't tell me you need £5,000 and I should provide everything, £5,000 for you to start the business. You need to be able to pull people together in terms of crowdfunding, subscribe, buy into my idea. You need to sell your idea to some people that will contribute. And when you have something to start, you can now go to the bank. We want to start business. We need 50,000 and we've got 20,000. Can you give us 30,000? So which means the risk is shared. Bank doesn't want to carry, or any lender doesn't want to carry 100%. So those other people that comes in with equity, they will be part of decision maker. That is why they are going to expect higher return. So you should be able to sell your idea, just like my son, is just in S2. He said, Daddy, I want to start producing perfume. And he comes up with Ross feasibility study. I said, you mean I should give him a salary? You are in S2 to start production of perfume? He said, you know what? Your birthday gift, how much do you need? 1,000, 2,000, say 2,000. Your birthday gift is £250. I'm going to invest it in it. Then we are going to look at your savings and pull out 1,000, and I'm going to invest 500. Your mom is going to invest 500. He said, but it's going to be family business. I said, no, the risk has to be shared. So you have to ensure those who have stake in the business have something. So bank knows that there is a margin that can save them. So when the problem starts, before it gets to the bank fund, they will have pulled it out. So when you start incurring loss, you lost 10,000, they know that the 30,000 is still safe, you lost 15,000. As at that point, the bank may call back their 30,000 because they don't want to lose it. So you need to have a stake by looking for other source of financing, which are the crowdfunding or equity investor or private placement from friends and family.
Now, talking of which friends and family, Ayo, say for example, I set up a limited company and I invest my personal saving and I get my friends and family also to contribute toward it. But I myself is an entity, the limited company itself is an entity. Can I, and how much in terms of percentage within the law, instead of friends and families becoming stakeholders or shareholders in the company, they want return on their investment, meaning giving loan to the limited company, X amount of money, but within a year, they want the money back plus interest. Could you please enlighten us on this?
In that case, that's not an equity. In that case, that is a loan from family and friends. In that case, they are saying we are not part owner of the business. We are just lending you money. So it's a loan, it's not an equity. An equity will not demand interest. They will have to wait for you to make profit. If you make profit, they get profit. If you don't make profit, they share the loss, everybody stay until when there's profit. But when it is a case of, I'm giving you X amount and you're paying back with interest, in that case, it is not an equity, it's a loan. Loan can come from anywhere. It can come from family and friends. It can come from bank. So most people will prefer to have loan if they are not convinced that the business is going to grow. They are not totally convinced. Instead of investing in equity, they will give you loan because they want to. And some will give you loan and says, this is going to be a convertible loan. After 3 years, we have option of converting it to equity. And you can also sell that as a bit. Give me the loan for 2 years. After 3 years, you have option of converting it to equity. We call it an hybrid financing. That's a debt equity conversion.
Yeah,
So
but Look, banks are not as friendly for small businesses because when you want to expand or when you see opportunity out there, banks even take a business plan, but you might have the best cash flow and best business plan, and you know this plan is going to work and you tested it, but banks are not there to finance us. Look at the current situation with the interest rate going up. Banks are pulling a lot of the small finances away from small businesses.
Okay.
Because they're not, because this is where I find banks and government don't want to ask small businesses to survive. Because if you are to take a loan of 20 million, because this is where commercial lending kicks in, because before the credit crunch, it used to be 2 million, now it's 20 million. And then you can set your own rates and set your own conditions, how you pay. And you can always roll over the interest. But at this moment, small businesses are finding it very difficult to sustain with the current situation that the banks are not that friendly. And a lot of the incentives, even during the credit crunch, when the interest rate went down to 0.25%, it wasn't passed on to small businesses. So that's something like when you say banks will do this, banks will do the banks didn't pass that on to us as a consumer. It only passed it to their big corporates. So that's where I raised the question, how do you get the banks to give us the money? Because there must be some kind of platform. The government have to have a lobbying system where small businesses are eligible to tap into that market, because there's a lot of assets out there. And there's a lot of small businesses, people like myself, yourself, which can do a lot of business. As you come from financial background and as you mentioned, you're an accountant, because taxation is one of the biggest killers. If you go to Tesco, they pay a flat line and projected VAT. So 5 years of flat line and projected VAT, they can use that as their cash flow incentives to expand their business. We as a small business have no facilities like this. We have to pay end of the 6 weeks period. So we are not given that opportunity. We are not given that flexibility. So that's that's the question I raised. How do you get the banks to move on and give us the money so we can expand? Because I'm sure everybody who are listening to this, they all would like to expand on the basis and benefit from that incentives, which government is always saying, look, you are eligible to this.
Yeah, thank you very much. You see, you said something, and what you said was that you said now, it's tough before now, but now it's tougher. And the reason is because the economic situation. You see, bank, there is something the business owner doesn't understand, and some do, is because you are taking from surplus unit to deficit unit. You see, in this season we have now, there is more demand of cash by the surplus provider. So those who used to leave the fund as savings, which are aggregated and give to business owner, they are not spending the money. The savings is not as high as it used to be before the increase in the cost of living. So the savings are shrink, and people are not saving as much as they used to. So the surplus is not as much as before. And bank needs to be very, very careful, because the money does not belong to bank in the first place, as I've always said. It belongs to another party, the surplus party. And the surplus party we're talking about is you and I. The little savings you leave in the bank are what they aggregate together and give to you to do the business. And then that they know you are taking an higher risk, which the owner of the business are not ready to take. So when they look at your business and they're not convinced, why? Because you are a startup. There is no track record. You are just starting. For example, when an organization like Amazon need loan, they are not going to be on the same footing with a startup, because they believe that they have assets that can back up the loan. They have customer that can back up the loan. But when you are just starting up, it's very difficult. I can tell you, if you become Elon Musk today, your story is going to change, because the bank believes that you have capability, you have risk absorber that can absorb the risk that you have, and you have assets and you have other business. But the reason why it is difficult to give new business is because of the track record. Bank is trying to play safe. Now, if you look at it, even when you're a first-time buyer, you have never bought a house before, banks are ready to finance the house. Ask yourself, why are they ready to finance the house and not the business? Because the property is there. Nothing is going to happen to it. It's going to be insured, even if there's fire outbreak. They are going to recover the money. So bank is looking at risk. They are not looking at making you a rich man. They're looking at the risk. They want to help you, but not at the expense of the customer. That's why it looks as if it's difficult. So what the banks need is convince us beyond reasonable doubt, because by now we have high sensitivity margin because of the economic situation. They believe now the probability that the business is going to collapse is even higher, more than ever before. So that is why it's difficult now. So the best way to go as a medium-sized business, as someone has said, look for crowdfunding. And when you are able to say, I have a larger stake, then they will give you. Because they look at you as an individual, they lift the veil of the incorporation, whether you're a limited liability company or not. They lift the veil of incorporation. Who is behind the business? What has it done? Okay, what has it achieved? When Elon Musk wants to buy Twitter, he got the loan. He got the loan. But you try it for a small business. You may not get the loan because you don't have track record. So you need to build your track record. And when your business grows, then bank will run after you. They will ask you, did you need the money? They ask me when I want to buy the house, because they know I now work, I receive salary, and they look at the stability of my work. I say, what happened before? They said, then the salary was not as big as what it is now. Now we are ready to finance you. And then my wife earned higher than me. They were able to finance my wife, and they didn't finance me. But now they want to finance me. So the bank wants to make profit, but also the first thing is the risk. That's why it's difficult to get the fund, because the fund does not belong to the bank. It belongs to other sector. And those sector, the withdrawal of people and the savings of people decide what we go from surplus to deficit. So you are on the deficit area, because the deficit area are the people that take risk. They take the money, and the banks takes the interest from you and give them little part of it. Because when you have a savings, either you get 0.001%. But when you want to take the loan, maybe you are being charged 26%. So they need to be sure that the 26% will come in. They don't want to have a toxic asset as a receivable. So the state of economy dictates that, the track record of those who are behind the business dictate that, the nature of the business dictate that, the sensitivity of the economy also dictates that. That's why. Okay. So keep growing your business. You will get to a point, then the banks will run after you. Any other question?
Such great information and amazing questions. Remember, AO's details will be on the VLE afterwards. So if you want to continue or have any further questions or would like some further information, please do email through. But AO, thank you so much for such an incredible session today. I think everyone got a lot out of that, and it was one of the most active groups I've seen this far. So thank you. Yes,
thank you, everybody. Thank you.
So for next
keep
week,
on striving, keep on doing your business, you will get there. Elon
yeah,
Musk, Mark, Jeff Bezos, they're just like you one time, but you can also get there. When you believe in yourself, dream it, then you achieve it.
Absolutely. Thank you so much. I'm thinking for next week to either we're going to bring some crepe beers to Republic, where we have the sessions and we can have a drink after the session, or we can all head to Crate and have some pizzas and beers. So yeah, let me know what your preference is, but otherwise my preference, I think, is to actually head there and check out the site and do all that. Otherwise Jen's going to bring beers to us. Let me know if there's any issues. I think it's like a 20-30 minute bus ride or so. But anyway, I'll check in with you all next week and we'll make a plan, but I'll see you on Tuesday. Remember your peer group sessions on Thursday. Enjoy the rest of your week. Thanks, everyone.
Okay, bye-bye, Jessica.
Thank you very much.
Take care.
Thank
Bye.
you, Ayo. Thank you.
Thanks,
Bye-bye.
guys.
Bye. Bye.
Bye-bye.
Bye.
Thank you. Bye.